This topic is about derivative features from learning module, derivative instrument, and derivative market features. There is a 90-day wait between signing the sales contract and actually receiving the Japanese yen. During these 90 days, the Japanese yen to euro exchange rate can change a lot. The euros they finally get can be much lower. A derivative, usually a forward contract, lets them lock in the exchange rate today for the payment they will receive in 90 days. Forward rate agreement, or FRA, locks in an interest rate for borrowing in 6 months. Both sides must settle the difference in cash when the period starts. If the derivative forces both sides to exchange cash flows or settle in the future, it's a firm commitment. Examples: forwards, futures, swaps, FRAs. Interest rate cap is an option. You pay upfront for the right to be protected if interest rates go too high. You only get money if rates rise above a level. It's a contingent claim. Credit default swap, or CDS, is purchased for protection. This is like insurance. It only pays if the bond defaults. No payment if nothing bad happens. If the derivative gives a choice or only pays if a bad event happens, it's a contingent claim. For example, options, caps, floors, CDS protection. A forward contract forces both sides to buy or sell the oil or settle the difference at the agreed price on the future date. No choice for either side. That's a firm commitment. Warrant is a long-term call option given by the company. The holder has the right to buy shares later, not forced to do it. It's a contingent claim, like an option. A put option gives the holder the right, not obligation, to sell the bond at a fixed price. American style means they can exercise anytime. It's a contingent claim. Derivative is a financial contract that derives its value from the performance of an underlying asset. Market participants use derivative agreements to exchange cash flows in the future based on an underlying. A derivative does not directly pass through the returns of the underlying, but transforms the performance of the underlying. This topic is about derivative underlyings. This is currency risk, foreign exchange risk, not timber price risk. To hedge currency risk from future foreign currency receipt, use a firm commitment with currency as underlying. Exporters who receive foreign currency often enter forward contracts to sell the foreign currency at a fixed price in home currency. This is a firm commitment. Option A is wrong underlying. This hedges timber price risk if price falls, not currency risk. Also contingent. Option C is wrong. Buying USD would hedge if you had to pay in USD, the importer. Here, Pinecraft receives USD. They need to sell USD, not buy more. Long fixed rate bond portfolio wants to reduce sensitivity or duration. We need to short fixed rate exposure. Pay fixed, receive floating swap equals short fixed rate bond plus long floating rate bond. It lowers duration. Investment managers use interest rate swaps to increase or reduce portfolio duration without trading bonds. Options, calls, puts are contingent claims. They are not firm commitments. This topic is about derivative markets. OTC market is customized contracts. Terms such as notional amount, maturity, reset, or payment dates can be made to exactly match the loan. Perfect for precise hedging of a specific loan. ETD market is exchange traded. Standardized contracts only, such as fixed sizes, fixed maturities, fixed reset rules. It's hard or impossible to match $175 million exactly, quarterly SOFR resets, and 4.5-year maturity perfectly. In finance, novation is the moment a central counterparty, or CCP, steps into the middle of a trade. Before novation, Bank A and Bank B owe each other money. After novation, the CCP replaces those two contracts. Bank A owes the CCP owes Bank B. The original two banks no longer face each other. The risk is now between each participant and the CCP. Futures live on an exchange. They are standardized, such as fixed dates, fixed contract sizes. The exchange guarantees the trade, so default risk is very low. They are transparent and public. Forwards live in the OTC world. They are private agreements between two parties, like a bank and a company. They can be customized to fit exact needs, such as any date, any amount. Because they are private, they carry the risk that one side might not pay, the default risk. After the trade is executed on a swap execution facility, the details go to the CCP. The CCP replaces the original contract. This is the novation process. It substitutes the original deal with two new identical contracts. One where CCP is buyer to the original seller, and one where CCP is seller to the original buyer. This legally inserts the CCP as the single counterparty to everyone. Netting is combining multiple payments into one net amount, used in clearing, but not the insertion process. Standardization is making contracts have fixed terms, happens in ETD markets, not the CCP insertion step.